Behind real estate, the stock market is the second greatest wealth generator of all time. It may seem like a confusing and winding road, but the path to understanding the stock market is the key to understanding money in modern times. The stock market is how the rich, the wealthy, and the upper middle class make money, even during a worldwide global pandemic. No matter how murky the waters of the economy, the stock market has become its own beast, with its own logic, generating wealth for those who are invested. Today, we hope to help everyone understand what a stock is and what the markets are and why they are so important for keeping your finances in the black. Hello and welcome to another episode of In the Black. I'm Troy, and today's episode is going to cover stock. By the end of this video, I want you all to be able to answer 4 questions confidently. Number 1, what is a stock? Number 2, what is a dividend? Number 3, what is an exchange? And number 4, what are indexes? Let's jump right into it. A stock is all of the shares of a company in which ownership is divided. Those shares are simply known as a company's stock. A single share of a company stock represents just a fractional ownership of a company. For example, most people know that Jeff Bezos is the richest man in the world because he founded and owns Amazon, one of the largest and most influential companies in the world. But the reality is Amazon is a publicly traded company, so its ownership is divided into millions of shares, and any paying member of the public gets to buy those shares and have a tiny piece of Amazon. As a result, Jeff Bezos only owns 11% of the company. That's right, the richest man in the world is the richest man in the world because he owns just 11% of Amazon. That goes to show you just how large Amazon is. But he is the largest single shareholder of Amazon, and the other 89% of the company is owned by the public, which includes some other companies and shareholders like myself. The stock of a company can be privately held, which means that the stock is exclusive to the company's founders, insiders, and even its employees. Your average Joe cannot walk up and buy shares of a privately held company. The board in the company itself has to decide who and when and how they'll sell those shares. Private companies are just that, private. Their ownership, the sales of the shares are up to the sole discretion of the company itself, and its finances and internal affairs are secret to that company. A company can also go public like Amazon, which means its shares will become available to the general public and trade on the exchanges that we now have. According to historians, the first company to ever go public is the Dutch East India Trading Company in the 17th century. A company that has gone public is subject to public rules and regulations, and its finances are an open book to the public. Anybody who has the money can buy shares, which means you buy tiny pieces of ownership of that company, even if it's just a tiny fraction. Owning shares of a company allows the shares you own to grow along with the company, so as long as you hold them. When Amazon went public back in May 15, 1997, the initial public offering was $18 a share. Today, as I am making this video, Amazon trades for about $3,200 a share, and that doesn't include the numerous stock splits that Amazon went through over time, which means that that original share became multiple shares of what the share price is today. More on that for another video. Now imagine buying a bunch of those shares. If you would have taken your savings of $10,000 way back in 1997 and bought as many of those original shares of Amazon as you could, today that investment will be worth over $12 million. That is how you grow wealth. Now obviously every company is not as successful as Amazon, but that is the long-term goal when you are holding the shares of a company. You are hoping that company is successful and grows in value so that your shares grow in value. The price of one share is simply known as its share price. In simple terms, that price should be the value of the company divided as a whole, divided by the number of ownership outstanding. But the reality is that the share price is whatever the market is willing to pay for it, based on a number of factors such as sales profits, regulation changes, future projections, There are companies that have yet to turn a profit at all, but what they do is considered to be valuable in the future, and therefore the price of their company grows, which means the individual share price of their company grows. Some companies even pay out its profits based on a proportion to the number of shares outstanding directly to those who actually own those shares. This is called a dividend. For example, I own shares of the Coca-Cola Company, and every 3 months, Coca-Cola pays out some of its profit to every shareholder based on the number of shares outstanding. This year, in 2020, Coca-Cola is paying out 41 cents for every share of Coca-Cola I own, and they pay that out every 3 months or quarterly. Not every stock pays dividends, but the stocks that do pay dividends are nice because they allow you to both own the company and the price of that share grows over time, and the profits that company makes gets paid out directly to me that I can use for whatever I want, including reinvesting it to buy even more shares of the company. So now that we understand stocks and dividends, it's time to discuss how they're bought and sold. When you buy a share of stock, you're buying it either from the company directly or a private individual who has it and is willing to sell it. The people who facilitate those trades are called brokers, stockbrokers. If you remember, I just said that the first publicly traded company was the Dutch East India Company. Well, in order to make it easy to buy and sell their shares, they created the first exchange in Amsterdam in the early 1600s. Here in the United States, the heart of our stock exchange is in New Amsterdam, or what we now know as New York City. Back at the founding of our country, if you wanted to buy shares of a company, your stockbroker had to show up at the auction house and hope somebody was selling their shares in between the wheat and tobacco and everything else that was for sale at that time in this country. Eventually, the stockbrokers got tired of that and wanted a more efficient process. So, in 1792, 24 stockbrokers met on Wall Street and established an agreement that would become the foundation of today's New York Stock Exchange. Finally, the people who would trade a stock came together to create one centralized place and agreed to the methods of how these stocks are going to be traded and what the commission rates will be and the process for making it all nice, quick, and efficient. The New York Stock Exchange has grown over time and updated its methods, of course, with along its technology, but the reality is it still stands today, one unbroken exchange, and is now the most powerful financial center in the entire world with over 2,400 stocks listed for sale. The New York Stock Exchange was a powerful and exclusive club. If you wanted to trade stock at that time, you needed a seat on that exchange, or you had to go through a stockbroker that does. Those brokers created companies called brokerages around those seats that they held on the stock exchange. They used that to facilitate trades and grow their own wealth over time. When you hear names like J.P. Morgan, Edward Jones, Charles Dow, or Charles Schwab, they were people who once held seats on the New York Stock Exchanges, and they used them to create massive financial companies that exist to this very day. What started as just 24 brokers grew to 1,366 seats on the New York Stock Exchange, all the way up until the year 2006, when the New York Stock Exchange became a publicly traded company itself, dividing its shares to the 1,366 seat holders who then became shareholders. Now, any personal brokerage can buy a license to trade on exchange, and it's all open to the public. This is part of the reason why trading stocks has become more accessible to the common person. The New York Stock Exchange stood alone until February 4th, 1971, when the world's first electronic exchange was created in New York, and that was called the Nasdaq. As this exchange is and always was on the cutting edge of technology, most of the tech stocks, even today, such as Apple, Microsoft, and Dell, and Intel, they all trade on the Nasdaq. Other exchanges have grown all over the world in global financial centers such as London and Tokyo and Shanghai, but with modern convenience, now anyone can find a brokerage of their choice, trading on almost all the exchanges, all from the comfort and control of their own phone. Finally, the stock market is always discussed when it comes to the economy. To look at specific sectors and metrics, the indexes were created to monitor entire sectors. Charles Dow and Edward Jones created the Dow Jones Transportation Average first to monitor some of the most important stocks being traded back in early America, which were the railroads. Today, that's been updated to include the airlines, trucking, and delivery services such as UPS and FedEx. The most popular one we hear of is the Dow Jones Industrial Average, which early on in America was looking at major industries such as steel and oil and gas production, things of that nature. They were the largest companies in America at the time. Today, the Dow Jones Industrial Average monitors roughly the largest 30 companies in the country. Then there's also the S&P 500, which monitors roughly the 500 largest companies in America today. These indexes help brokers, economists, and anyone in the know watch the overall health of not just the entire market, but very specific sets of industry and companies based on their size and stability. These provide the barometers of how the financial market is doing, and it's why you hear the daily news and you see the ticker tape, and they'll tell you the Dow Jones is up X number of points today, and the S&P 500 is up today, and we get an overall view of the health without having to look at individual stocks of any one company. There are plenty of other stock indexes that all monitor a specific industry or set of stocks. I know this was a lot of information we covered in a short amount of time today, but this was truly the short and the simple for it. We want to give you the basic foundation and understanding required to gain confidence to begin investing yourself so that your money can work for you by growing over time in the market. Because the reality is, that is what the rich and the wealthy do, and even the upper middle class. Leaving your money to sit in a savings account to get less than 1% interest pales in comparison to putting your money in, say, the S&P 500, which grows on average about 6 to 8% over the last 20 years. That's a significant boost to the rate of growth of your money over time.
Thanks, Troy, for dropping some knowledge about the stock market and a little history behind it. Sometimes it's important to know that history because you want to be knowledgeable about what you're investing your money into. The old adage goes that a fool and their money are soon departed, and we don't want to be the fool. So I'm glad that we got a little bit of history about what the stock market is, kind of where it came from and how it started, and kind of where we're at today. Now, leaving you guys, I want to give you 4 key takeaways that will get you started on your journey to investing in the stock market. Here we go. Number 1, first you need to decide what stocks or funds you want to invest in. Now, I know this can be a little bit of a daunting task because if you're new to investing in the stock market, you're like, what stock do I invest in? Which fund do I invest in? I'm hearing all these terms thrown around, P/E ratio. I'm hearing about large cap, mid cap, small cap, in all different industries I can invest my money in. And it definitely can be overwhelming because there's a lot of information out there. And guess what? It's really tailored to what you want to invest in and what your risk tolerance is. Now, you need to do a little bit of base research, do a little bit of asking around, asking questions, and don't be afraid to sit on the sidelines a little bit while you're trying to go and gather that information. That being said, funds are a great way to get started in investing. And guess what? We're going to do a video on using funds to invest in our next episode. So stay tuned for that. Number 2, brokerage accounts. Now, a brokerage account is simply an account that allows you to invest in the stock market. There's a lot of people who will tell you should invest your money with this brokerage or that brokerage, but at the end of the day, you have to figure out what works best for you. Some people are more comfortable investing their money with more traditional, stronger, long-lasting brands like TD Ameritrade, Fidelity, Vanguard, all solid companies. They feel more comfortable having their money with them. Some other people really want to have more of a cutting-edge brokerage. Usually they're going after something like Webull or Robinhood that has a way better UI, makes trading stocks a lot simpler and easier, and more straightforward, especially for people just getting involved into the stock market. And the final type is robo-investing with a company like Betterment. Now, robo-investing, as the name suggests, is a computer algorithm that will tailor its investments for you, so you don't have to pick your stock. So this is good for people who do a little bit of research, ask a little bit of questions, but at the end of the day, still feel overwhelmed about picking what individual stocks or funds they want to invest in. So robo-investing might be better for you. It'll let you tailor the investments. The algorithm will tailor its investments towards what your risk tolerance is and also what your goals are. So that's also a good alternative. Number 3. All right, number 3. So number 3 is also very important, is setting your budget. Now you have to realize that any money you're choosing to invest could be money that you're potentially losing out on. And as your investment could potentially go to zero, that's why it's called investing, okay? And with that in mind, you need to be investing money that you're 100% okay with losing. That means that it's not money to pay the light bill, not money to pay your rent or mortgage, not money to put food on the table, because if you need that money, then it's not money you should invest into the stock market. But this is money that you have dedicated that you're going to put in the stock market and leave alone. Okay, this is money that is you're okay totally losing out. It's unlikely, but as we saw earlier this year with the epidemic, the stock market can take a huge plunge, and that's part of the risk of investing. So what you want to do is to make sure that the money you're investing is money that you're okay losing. It's also prudent of you to make sure that the money you're going to invest comes out your account on a regular basis. Now, whether that is for you on a weekly basis, whether it's on a monthly basis, whether it's every paycheck, however you decide, whatever works best for you and your family. But you need to set up that budget, and especially now with a lot of brokerage accounts, they allow you to set up automatic withdrawals or deposits that you can take from your checking account into your brokerage account, and it's very seamless. It's automatic. You don't have to worry about it. You kind of set it and forget it from that standpoint. And that's important because you want to groom yourself with the idea that this money is set aside for investing. You don't get tempted not to put that money in investment if you try to do it manually. So it's very important that you set a budget for yourself and stick to it. Number 4, finally, our last key takeaway point is leave your investment alone. I'm serious, guys. You have to make sure you leave your investment alone. And when I say that, I mean, don't be excited when you start making some gains and you start feeling yourself and you go in and say, let me go ahead and treat myself to a new pair of shoes, or go out, on a night of town, or, let me go take this girl out on a date. Whatever the case may be, leave it alone. It is important that you sit there and you let your investment grow. If you're tempted to dig into your investment, you probably even shouldn't look at your account on a regular basis, because if you take money out, you're really doing yourself more harm than good. The only reason you should be taking money out of your investment is in extreme emergency. I'm talking about that you are really, you really need the money, that you've burned through your regular checkings, your regular savings, and your emergency savings, which you should have. Then the only thing left is your investments. That should be the last thing that you ever touch. The reason behind this is what we talked about in our last video, compound interest. When you start taking away from your investments, you really limit its growth potential. Remember, we talked about the snowball, where with compound interest, the snowball starts off small, but it gets really large over time. And if you take money out, then you're really missing out on some huge potential gains, guys. So make sure that you just leave it alone. Kind of set it and forget it. Don't touch it, no matter what. All right, everyone, thanks for watching the video. We really appreciate the love and the feedback. Let's keep it going. Please make sure, please, to hit the like button. That helps the YouTube algorithm, boost this video up for other people to hopefully get some useful information out of it. Please make sure you subscribe so you're kept up to date with all the new content that we're going to continue to push out. And make sure that you comment with any ideas or any questions you may have. We're going to be looking at the comments. We're going to be doing our best to answer any questions. Once again, we're excited to take this journey to financial freedom with you guys. We hope that you guys stay tuned, and we hope that to grow and build together. And we always hope that we can stay in the black. I know that was corny.